So far today, the S&P 500 looks very strong. We have the majority of these stocks up a very nice amount, but today our focus is going to be on 3 growth stocks that have been hit very hard. Now we'll just run through each one of them just in case you don't want to continue on the episode. We're going to be talking about Lululemon, which is down around 53% year to date. We're going to be covering Ulta Beauty, another one hammered down 33%, and finally we're going to get to Celsius Holdings, the energy drink, as we can see, down around 27. Now you may have noticed each one of these are at their 52-week lows. We're going to look at their metrics as well as our own valuation, what we see in terms of upside. Now some of the reasons that we are seeing a lot of these consumer discretionary stocks getting hit hard, we have a lot of articles over the last few months talking about how the American shopping spree is starting to lose steam. We even have evidence that the American shopper is cutting back, and one of the reasons that we do see a lot of this information come up is effectively we have had a lot of years of inflation fatigue where we've seen the general market use the inflation as an excuse to continue to hike their prices, and it looks to be like consumers are taking a step back and now spending less monies with these companies. And as we mentioned, US stocks feeling that effect with consumer spending starting to slow down, and that is why those companies we just talked about have been hit very hard. Now there are also a few other ones, and in fact we've covered these in terms of their results not too long ago on the channel. McDonald's, Starbucks, a lot of these companies in fact reporting a double miss. They're seeing footfall within their own stores drop dramatically. In fact, we're talking about lows and not seen for at least the last 4 to 5 years. But also, interestingly, one thing that we have seen with Uber, for example, who did report their earnings just yesterday, they are actually seeing growth in both their bookings for delivery as well as their ride hailing. Now, the main thing that we want to point out from all of this information is that when we look at the overall picture of consumers and their spendings, they are starting to hold back on a lot of purchases that they may have made over the last few years. Now, the first one that we're taking a look at is Lululemon. Now, as we can see, this has been absolutely obliterated, down around 53% just year to date. It does trade now right there at its 52-week low, and we do get a double buy rating with a hold from Quant. And we do know the forward P sits around 16.51. Now when we expand this over the last 10 years, they have still significantly outperformed the S&P, up around 530%, but they have fallen quite some way from all-time highs that we have seen within the last year, in fact December, at around $516. Now when we take a look at their actual earnings, what is interesting to note is that over the last 4 quarters they have beaten analyst targets on the earnings per share, and moving forwards over the next 4 quarters they are anticipating high single digit to effectively double digit growth continued as well. So ultimately, if they do hit their earnings per share over the next few years, that forward P will come down to around 15.1. And the question to answer is whether or not we are seeing this growth slow down dramatically enough that maybe these companies are in fact reasonable in the drops. Now, when we take a look at each one of these companies individually, the first one we're looking at is the free cash flow metric. We can see their growth has been very strong over the last 10 years. Granted, maybe not as consistent as we want to see, the drop from 22 to 23, but we see it rebound and continue to increase over the next 12 months. So we also want to understand throughout the episode, do we see some market overreaction? Because ultimately when we do come to it, each one of these does have a lot of upside. We can also see with Lululemon, their sales growth has been double digit every single year, and the more recent year of FY24, their top line is up 19%. Now when we expand this over the last 10 years, we can see they have grown their top line at a very strong rate, more than quadrupled as well, and the growth also seems to have continued over the last 3 years. Now they also have done some share buybacks, although very minimally over the last few, but again something that is quite nice as an added bonus, as ultimately you do retain a larger portion of the company. Now, one thing that is fantastic with this company and that we say a lot is not just the fact that the ROIC is above that 10%, but we are seeing that consistency throughout the years. And ultimately, I do believe when we get consistency in metrics and expected moving forwards, that it is worth paying a little bit of a premium for those companies. Now, we do want to see 10% or more to give us faith that management are able to effectively allocate their capital, and that is exactly what we see. Another thing that is very nice to note is the margins over the longer term have been increasing, only marginally, but still nonetheless that is one side of operating efficiency, and ultimately a high quality company has two signs among others: increasing top line, which Lululemon ticks off, and an increasing margin that we can see here as well, although marginal, still better than just staying stagnant. Free cash flow as well, very nice to note, higher than the minimum 5% that we want to see for 9 of the last 10 years, 17% in 24, and on the trailing 12-month basis, 18% also looks very attractive. Now the final metric that we look at on this channel is the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization, and what this shows us are the number of years it would take Lulu to pay off their debt net of cash on hand. In fact, the last 5 years, moving forwards as well, it wouldn't even take them 1 day. So fantastic balance sheet that does show us the balance sheet strength. So that is something we do like to see on this channel. And ultimately, we do run each one of these companies into our intrinsic value. Now, before we continue, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So how we got to the $320 mark, we run it through the DCF model where we have the free cash flow year on year. We have the average growth of 19%, and moving forwards we have gone for 3 different growth rates: a low, medium and high, and we've used the medium today at 15%, which is quite lower than the average of 19%. And with the discount rate, we get the present value of future free cash flow and terminal value. We add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, and based on that 15% moving forwards, we see upside of 33%. Now, there are people that will say you need to be more conservative, so at the 10% level, just for transparency, we can see it would come to around $236, and that says around downside of 2%. You could argue then right now it is factored 10% free cash flow growth moving forward. Conversely as well, you'll get people that say that is way too low and you need to be around the average. So if we go for around 20%, as you can see, $432, upside of 80%. As always, these numbers are subjective. You can grab a copy of this model on the pinned comment below, running through your own numbers, whether it's for Lulu or any other companies that you're interested in. So let's take the 15% into the next slide, because ultimately what we do on this channel is we add an extra layer, which is a margin of safety, and at the 10% point, we use this execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, then ultimately it is a buy up to around $288, and we keep going till it's near the current trading price. And what we can see in today's episode, you are getting a bang on 25% MOS with Wall Street, who are bullish on this. They have a price target of $373. They see upside of 55%, which is in fact higher than our own intrinsic value. So this definitely looks like one to capitalize on the drop that we have seen year to date. But as always, do let us know your thoughts in the comments below. Now, before we move on to Ulta Beauty, just to let you know, we have released our latest free weekly article. If you want access to this or any others, you can read them straight away by clicking on that pinned comment below. And we also have released our August undervalued stocks, 35 of them that you can read, and we talk about each one that is within our own portfolio. Moving on then, we have Ulta Beauty, another one hammered down 33% year to date. Again, trading at its 52-week low, double buy with a hold from Quant, and we can see at a reasonable 12.51 forward PE. Now, over the last 10 years, if you have been a shareholder, another one that has significantly outperformed the S&P, and we can see not too long ago, all-time highs in 2024 around the $575 mark. When we look at their earnings, well, we do note again, very similar to Lulu, the last 4 quarters, they have beaten analyst targets. Now, next quarter, they're anticipating high single-digit decrease year on year of 8%, although the next 3 they are anticipating growth a little bit mixed, as we can see. Now, if they do hit the EPS estimate, the forward PE will come down to around 11.4. Now, as we mentioned, looking at their underlying metrics, we can see another one with some very strong free cash flow growth, 229, in fact nearly 10 times over the last 10 years, and anticipated to increase over the next 12 months. Very similar to Lulu, nearly double digit every single year. Granted, we had that COVID lockdown, so therefore 2021 numbers are down 17% and 10% in 2024, which when we do zoom out, we can see more than 3 times growth to their top line over the last 10 years. And one thing that they do very nicely that maybe we didn't see enough of for Lululemon was the share buybacks. Pretty consistent, even at a small rate year on year, is still something that we love to see for shareholders. We also note ROIC numbers every single year, bar COVID, looking very strong. These are some numbers that you shouldn't take for granted. Just take a look at some of those in your own portfolio. I guarantee not many of them will be as high as these two companies we are talking about. Then we take a look at the margins. Now, ideally, we want to see around 16% as a minimum. So it does straddle around that. The last few years, 15 to 16. As a minimum, we would want to see them keep it at this level, but as we talk about, increasing over the longer term. We then get to the free cash flow margin, minimum 5%, which is what we see, and it has been increasing as well, which is something nice to note. Finally, the net debt to EBITDA, whilst it isn't zero like Lulu, 0.49 in 2024, marginally higher over the next 12 months, so we can see here again another very strong balance sheet for Ulta Beauty. Now when we get to the price, well, our intrinsic value at $485 isn't dissimilar from Wall Street's target around 468, where they see 42% upside. Now how we got to this value, when we put it through the DCF model, we have a low, medium and high growth rate, where we can see their average in fact is around 48%. Now we have gone for one of the worst case scenarios at a 4%, which we deem to be low, and that would give upside of 47%. As you can see, for example, if we do put 8% into the model, that would give $656, which ultimately believes over the longer term, if you see them getting an 8% growth rate to the free cash flows, right now you would be essentially buying this company at half its intrinsic value. Today though, we are going to take the 4% rate into the next slide and use our margin of safety. At the 10% level, then we have a buy up to $437, and we keep going till it's near that current trading price, and we can in fact see in today's episode, not at the 35% level yet, but you are getting at least 30%, with, as we said, Wall Street giving this 42% upside over the next year. As always though, give us your thoughts whether any of these two so far are ones that maybe you're considering or that you have already started to buy and believe over the longer term they will look to be very, very good buys in the not too distant future. We then move on to Celsius Holdings, where we have a double buy and a sell from Quant, again trading right there at its 52-week low, down 27% year to date, although over the last 10 years, phenomenal performance, up 22,000%, and we can see a forward P sitting around 38.1. Now, when we look at their earnings, they also reported not too long ago, they have a 75% track record. 3 of the last 4 quarters they have beaten, although bear in mind, over the next quarter, they're anticipating double-digit decrease, and then moving forwards, nearly double-digit for the subsequent 3. Now, if they do meet the EPS estimate for 2025, forward P will come down to just under 30. In terms of the metrics, well, they had negative free cash flow pretty much year on year up to 2022, where we did see it turn positive and anticipated massive growth over the next 12 months. When we talk about sales growth as well, double digit every single year. The question is whether or not we are going to see a massive slowdown in that growth. 102% in 2023, 56% on a trailing 12-month basis. We then look and zoom out and we can see the massive growth to the top line over the last 10 years. But unfortunately, we do have to say that they would have diluted your position over the last 10. But again, you probably wouldn't care, to be honest, with the massive growth you would have seen over that period. Now, no surprise when we look at the ROIC, out of the last 10 years, we only know 2 years where it is positive, and this indicates to us that they haven't turned a profit other than 2020 and 2023. Now, hopefully, one thing to bear in mind is that we can see them continue to turn positive numbers and, in fact, report a net profit. 24% very strong in 23, 27 on a trailing 12-month basis is a good sign for that continued positive bottom line. Then we move to the operating margin, where again, as we said, it would be negative given 8 of the last 10 years were negative. 20% in 2023, much better than the 16 we want to see as a minimum. 22 on a trailing 12-month basis, so hopefully it can continue to increase with the top line that we are expecting to grow at a very rapid rate. Free cash flow margin as well, the last 2 years looking good, 15% on a trailing 12-month basis, again, something we like to see. Net debt to EBITDA, well, the last 5 years and expected over the next 12 months, very, very strong balance sheet. Won't even take them 1 day to pay off all of their debt net of cash on hand. Now, our intrinsic value comes to $52. We can see Wall Street see this at much higher at $67 with upside of around 73%. Now, the reason we got to this value, as you can see, the low, medium, and high rate, 20, 25, and 30, what we have noticed over the last year, it did increase by around 24%. Bear in mind the large negative numbers will have skewed these performances, but moving forwards, as we saw, the free cash flow is anticipated to grow at a very rapid rate. So again, very subjective. If you use the 25%, you get the $52. At the 30% level, again, just for transparency, around $71. And if you do believe 20%, well, that will be around $38, which at negative 2% upside, you could argue right now baked into the numbers is this moving forwards at a 20% level. As always though, do give us your thoughts below. So moving at a 25%, again, we have revised this a little bit lower, so you could argue that this is very conservative. We do always apply a margin of safety on top. Now at the 10% level, a buy at around $47, at the 20% level around $41, and in today's episode, pretty much getting a 25% MOS. Bear in mind, this is on the expectation they will grow at around 25% moving forward, and we can see Wall Street indicating $67 in terms of upside. They have lowered this from previous analysis, and they get upside of 73%. As always though, do give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click on the pinned comment below so you can sign up to the free weekly newsletter. And if you're interested, come and join us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day and we'll see all of you on the next one.